3, 2, 1, and starting the webinar now. Good luck, everyone. We are now live on YouTube.
Thank you. Thank you, everyone, for joining us. You will see the numbers at the bottom ticking up if you're on Zoom. Participants are continuing to join. But you are in the right place. This is the Usability and Data webinar series about the EU taxonomy, what it means for, drumroll, banks. We've looked at corporations, we've looked at investors, we've looked at introductions, and we've had special 2-hour long, that's long for a webinar, webinars on the social taxonomy and the second harm taxonomy proposal. Today, the last of our summer series on this taxonomy, important taxonomy conversation for Europe, we're looking at what it means for banks and a variety of approaches. We have a couple of fantastic guests with us. We have Nadia Humphreys from Sustainable Finance at Bloomberg, but more importantly, from my perspective, the co-rapporteur of the what's called SG5, the Usability and Data Working Group of the EU platform on sustainable finance. And we also have with us Gwen Yu, who's also a member of the EU platform, who's the head of Sustainable Business Strategy and Innovation at BNP Paribas, a bank. Yes, you got it, a bank. And she's had some practical live experience of wrestling this elephant. Well, it's really a cuddly panda bear of a taxonomy down to the ground and try to deal with the issues, what works, what doesn't work, and how to take it forward. She's going to join us in a minute. People are still dialing in, so give me a couple of more minutes. If you want to ask a question, there is a Q&A button at the bottom of your screen. Please use it. Avoid using the chat button because it just confuses us. We can only deal with one thing at a time. There will, however, be links which our very kind producer will put in the chat function to the other webinars that we have done so far. They're all available on YouTube. If in doubt, as the page in front of you says, you can search YouTube for Climate Bonds EU Taxonomy and you will find a cornucopia of information, of webinars, of videos, including Nadia, who's been involved in some previous ones going forward. That's the background to it. So this particular one, we will now get started. Whoops, I got a bit ahead of myself there. I think we've got enough numbers now, Nadia. I think we've got enough numbers, Gwen, so we'll get going. Nadia is going to lead us through some slides, and then Gwen's going to dive in with her experiences afterwards. But again, just scene setting. We have a huge challenge before us. You kind of know what this is, but let me just state it. We've got to get emissions down in Europe and globally by 55% by 2030 to have even a reasonable chance of creating a future for our children that is the sort of future we're willing to let them live in, that is not catastrophic. We will get more floods like we've experienced in Germany and Switzerland in the last few days, more heat incidences like we're experiencing in North America now, we have in the last few weeks, and more pandemics as we are still in the middle of experiencing around the world a brutal pandemic. These are functions of the collapse of biodiversity and climate change coming together in a perfect storm, which is leading to volatility in a wide range of areas. We ain't seen nothing yet. The volatility extends to all sectors of the economy and society that are influenced by the physical environment, and as we know now, also the environment of pandemics. There'll be other things as well. So we've got to prepare for that. There's a resilience agenda, but above all, to avoid catastrophic change, to avoid the kinds of incidences way beyond what we currently experience, because what we have now is going to keep happening to 2050. That's a given. We can't change that now. That was baked in as a result of the last 30 years of emissions we put into the atmosphere. What we have to prepare now is to avoid the catastrophic impact post-2050 if we don't shift the course of our global supertanker, of our global economy, of our global society. That's what we're on about. And this is what we really have to remember as we're thinking about that 2030 target. The 2030 target is about surviving post-2050. It's about that kind of world, as well as dealing with resilience, etc. Okay, that's the bad news. The good news is we are awash in solutions. The taxonomy shows you them. As we will look, if you look into the physical description of the taxonomy, there's a zillion and one things we can and should be doing to address the challenges before us. Of course, in the platform, we're also looking at other related areas, marine protection, biodiversity protection, pollution prevention, circular economy, and so on, which are all part of the broader patchwork quilt of this particular problem. We've also been looking at how we can mobilize the second extraordinary positive thing that we have going for us. We have the capital. We are awash in capital. We have, well, it's in Europe, something like 21% of all institutional capital, institutional investment capital, is in negative or zero interest rate bonds. Like, it's crazy. It needs to be put to work in places that will give us sustainable returns and a sustainable future. Of course, that's what we're trying to do in this taxonomy. But the taxonomy looks complicated at the moment. It looks complicated because we're in the design phase. Think of an electric car. If you get in one, you press the button, you drive. Beautiful. You never look under the hood. But of course, as you're preparing the car, it's complicated. We've got to make all these wires work together. We've got to design bits and pieces. We are still in this process going forward. We have a delegated act before the Parliament, which is the first wave of the taxonomy. It will be updated on an ongoing basis. That's what the EU platform is here to do. Of course, we're now looking at the taxonomy in application across all investors, banks and corporations in Europe at a common language that we haven't had before. This is the real prize of what we're doing. Comparability, linkage to incentives, and a variety of other benefits can flow on from having the common language. But now we need to understand it better. Okay, Nadia, at this point, I really need your help. Let's have a look at the slide deck, if we may. I'll go to the next slide. Over to you.
Thank you, Sean, and very much the weather is a topical start. I mean, I am presenting from 30-degree heat in this home office environment, and as much as I would like to do so like some kind of film star with a fan, it distorts the noise of the webinar. So any beads of sweat may not be my response to Sean's kind of hardline questioning, and more to the summer that we're enjoying here in the UK. So what is the taxonomy? And I think, Sean, you kind of did a good introduction of the positive aspects of what this really aims to be. And I think for those of us that have been in sustainable finance for a while now, people may query, well, I've already got a methodology. How is this going to be impacted by kind of the new layout of the taxonomy? So I think when we look at the market today, we do see that there is some confusion around what sustainable really means. And I think within this confusion, maybe there's the opportunity for what some might call mis-sellings, for others misrepresentation of what a sustainable investment truly is or needs to be to perform. So the taxonomy really tries to solve some of this by providing a kind of dictionary, or in our language, a compass, so the taxonomy compass, of what it takes within a certain set of activities to demonstrate what we call substantial contribution. Now, within those activities, there are 6 environmental objectives you see on this slide. As Sean mentioned earlier, we have defined what it means for climate change mitigation. So that's the impact you have on the environment, or climate change adaptation, which is the impact the environment has on you. And we are working, in fact, imminently to release, at least in the platform, some views from our technical working group around the remaining 4 environmental objectives. So if you are in work over the summer, we certainly recommend you look at the proposals that will be launched at the end of July around technical criteria related to the remaining 4 environmental objectives. So if we think about how do you measure against the taxonomy, if we can jump, Sean, to the next slide. The language that we use here is that an underlying investee company would need to demonstrate that they substantially contribute to one of those 6 environmental objectives, that they do no harm to any of the remaining 5, and that they also meet kind of a baseline minimum social safeguards. So when you start to lay out your process, you would like to see, number one, that a company you're investing in is meeting some key KPI related to substantial contribution. So if we think about substantial contribution to mitigation, this would be key KPI typically related to the carbon intensity, for example, of the production process in manufacturing. Do no significant harm is a more holistic view. In effect, you shouldn't really be investing in a wind farm that has deforested an area in order to exist. So you want to look at the treatment of local biodiversity. You want to make sure that there's appropriate environmental impact assessments for any project that you're looking to sponsor. And minimum social safeguards aligns itself with the OECD multinational guidelines, the UN guiding principles, and the 8 ILO conventions. For many investors, this is a baseline standard they would already be applying before investing in a company. So you're not investing in a company with poor human rights, with some kind of human trafficking, child labor violations against that company. So you're meeting kind of these bare basic minimum social safeguards. Sean, if we can jump to the next one, because I think we had an interesting, our very first Q&A popped up from Josh Summer around what do we do if a sector isn't covered? Well, at the moment, activities that we have prioritized represents about 80% of the direct greenhouse gas emissions in the EU, and you see these laid out here. So we've looked at the energy sector, we've looked at transport, we've looked at forestry within agriculture, we've looked at information technology as well as research and development, we've looked at the acquisition of buildings and the construction of buildings, and we've also looked at certain sectors within manufacturing. Now, across this, we've created a set of key KPI, and you will see them released from the Commission in something called a Delegated Act. So you will see a Delegated Act for climate change mitigation and a Delegated Act for climate change adaptation. Now, if you're wanting an easy tool to navigate through quite a lot of text, there is something called a Taxonomy Compass. If in any search menu bar you type Taxonomy Compass, it is absolutely my go-to resource, because you will then be able to very cleanly see what are your mitigation key performance indicators, what do you need to meet in order to demonstrate substantial contribution. And then very similarly, you will see what are your do no significant harm requirements at a company or investee level. Now, this isn't yet complete. So as Sean mentioned within the platform, we are continuing to expand not only environmental objectives, but also the sectors that we are covering. And very much the ambition would be at some future point in time, the taxonomy would have criteria that helps you understand the full economy, so that you can understand what it takes for a company within any sector to substantially contribute, or where there may be some sectors that have no significant impact, which I think you would have heard Nancy speak to in an earlier webinar around significant harm as well. Are there any, I'll pause there, Sean, in case there are any questions before I come to this one. Were there any bits that you were picking up on?
I'm going to say that on this slide, there's a lot of questions around the detail, but what I want to get to is how do banks deal with this? How do they manage the reporting side of it? Now, what are the special things for banks? There's a whole requirement here. So I realize Gwen's going to dive in on that, but maybe therefore I'll ask Gwen, is there anything to throw in at this particular point of the presentation?
The Compass that Nadia mentioned is really one of our go-to reference tools as well, because if you're looking at what it is that we're actually financing, and if you go back into what Nadia had mentioned on the decision tree process on how you would say something would be taxonomy eligible or aligned, this is really our first step. So first, is it covered? Second, within the Compass itself, it'll give you very specific standards and ceilings and floors that we would need to reach for each sector. So within that sector itself, does it meet the substantial contribution criteria? So this is really the first step when we look at the data as we assess our GAR, green asset ratio.
And does that pick up do no significant harm issues adequately for you?
For now, I think we're still trying to figure that out because this is really a work in progress. So for some of the do no significant harm, we would already be going through that as part of our normal KYC when we look at the transactions that we would be lending to. Know your client. So it's when you go into a bank and when you get a loan, you have a thing, you have a bunch of information that you're going to need to fill out. And some of that has ESG criteria. So some of that will have do no significant harm criteria, similar to minimum social safeguards, because this is really the minimum level of requirements that we have, at least us in BNP and the other banks out there, when we look at who we want to lend to.
So if you're in a bank out here, this is gold dust, right? We're using the Taxonomy Compass and KYC. I'll get into the jargon, yes.
Lots of letters.
There's a few questions coming up in the sidebar, but Nadia, let's just go for a couple more slides first. Is that okay?
Yeah, absolutely. So I think maybe one of the things that I get asked a lot of questions about, Sean, is that the taxonomy is a particular point in time and only shows you strong performers today. It has no concept of future performance. And when I'm asked those questions, I like to say that's not true. And this is our perfect example of thinking through the taxonomy and reporting under the taxonomy that relates to kind of future. So if we want to consider company XYZ, and I think, Sean, last time I did this example, I said cement. So today, to be a little bit interesting to those repeat listeners, I'll go for plastic. So let's imagine that you are a plastics manufacturer and you manufacture plastics through factories A, B, C, and D. Now, factory A is the only one that you're using mechanical recycling for. For B, C, and D, you're mainly, let's say, virgin plastic, or maybe you're using chemical processes that are not meeting the life cycle GHG relative comparison that's expected in the technical annex of the taxonomy. So let's go simple and say, factory A, you're using mechanical recycling, and there's a large portion of what you're producing that is coming from old plastics churned down into little pellets and then producing your plastic produce. So factory A is going to be meeting the technical screening criteria to substantially contribute. And let's also assume that this company as a whole is meeting minimum social safeguards and meeting do no significant harm. Now, only 20% of the revenue from factory A, only 20% of the revenue of the company is coming from factory A. So my first reporting as company XYZ is that 20% of my turnover is taxonomy aligned. Now let's start to think about the Capex, and I think we might have some animation in here, Sean, for us. So it's 2020. I'm going to be investing through capital expenditure in improving plant B. Now it uses chemical recycling, but it does so at the moment at a carbon intensity that doesn't really meet the life cycle emissions expectations in the taxonomy. But I'm investing in technology to improve my production from factory B. Now, the capital expenditure that I'm putting into improving factory B can count so long as at the maturity of the project, I'm able to demonstrate this substantial contribution. So if you can see here, we've got a 5-year time. So at 2025, I've now improved the amount of revenue I'm making from factory A. Factory B is now compliant with the taxonomy, and it's only C and D that are no longer in line. So 50% of my revenue is now taxonomy aligned, plus obviously the previous capital expenditure that has subsequently matured. And if we go the next 5 years, you can see that what company XYZ chose to do is close factory C and build a new factory E. And that capital expenditure in that program would also count as taxonomy aligned. So when I think about myself as a bank and I'm investing in company XYZ, I can definitely explain the narrative of a general purpose holding, so a general purpose loan with company XYZ as the percentage of turnover, so that number on the right-hand side, or the proportion of capital expenditure of company XYZ. Equally, if I'm actually holding a loan and the use of proceeds of my loan is going into the improvements of factory B or the creation of factory E, then perhaps 100% of the use of proceeds of my lending could be considered taxonomy aligned. So there's many ways banks can tell their story about the transition and how they're supporting companies operate at a higher level in line with the taxonomy. I'll pause here in case Gwen wants to add anything to this example from a bank.
That's a great point, Nadia, and that's exactly how we would use it. I think one thing to add is over time if we're going to put in there any kind of transition linked financial product, then we can actually look at this over time. And if the company itself, this plastic company, if they were actually walking the talk, and then we can have these use of proceeds loans that will finance B and E in the example that we have here, or potentially other revenue generating factors that hasn't really been incorporated yet here.
So what you're telling me then is that we can have forward-looking disclosure, right? That's the essence of this, right? And this could translate into bonds and other instruments as well over time. I mean, in the Green Bond Standard, we're allowing people to raise a green bond, this is the European proposed Green Bond Standard, and they've got up to 5 years to deploy the funds, which would have to fit this kind of model. They couldn't do 10 years under the Green Bond Standard, but under disclosure, well, how would that actually work? What would be the nature of reporting? If you're a bank, for example, around 10-year disclosure, I'm confused. Are you just reporting where you are now and your plans to go forward, or is it all mixed together somehow or other? Are the two separate disclosures or one?
We have a few disclosures that we would need to look at from a bank standpoint, but let's just take the main one, which is the green asset ratio. So within the green asset ratio, you will have things in there like loans, any kind of debt securities, equity securities, etc. Now, if we take loans, you will have two main types of loans. You'll have general purpose ones and use of proceeds ones. For use of proceeds ones, they're typically tied to expenditures. So this we will see here in order to fund Plant E, for example, you will probably have a use of proceeds loan, or you will help the corporate issue a bond for Plant E or part of this trajectory. But for the general purpose
which fully qualifies, just to be clear.
Which fully qualifies, exactly. Great. And for the general purpose one, if you're looking at revenue, then if you're only looking at this year, then it'll be a static look. It's not really going to be over time because it's the revenue that you have today. But it's kind of like how we do financial modeling now. If I were to do a valuation of a company, I will have historically what they've done, what they're doing today, and then I'll be able to see if the projections that they give me actually holds muster based on what they've done in the past and what their plans are coming forward. So it's kind of how the disclosures that we have now within revenue and expenditures lets us do both. One, it lets us see what it is today. And second, it lets us see where the company is going later and if that actually is in line with what they claim their sustainability strategy and commitments are.
Wow, this is big. This is new, everyone out there. This is not what we've seen in the past, our understanding. And of course, even in the green bond market, just alone, we've tended to have a 2 or sometimes 3 year look forward period before you've got to use the proceeds. The Green Bond Standard explicitly takes it out to 5. But how does the monitoring and verification, someone says they're going to have this, how exactly do we confirm? How do we have confidence in the system, Nadia? Is this ESMA that's going to be knocking on your door, or EBA, I should say, the European Banking Authority?
So for the Green Bond Standard, it in itself has a verification process. Mm-hmm. So there will be a set of approved verifiers who would need to conduct analysis to confirm that the use of proceeds are taxonomy aligned. And that's to help investors rely on the verification under the Green Bond Standard to be able to use that value in their own reporting. Just to make it clear, because I know we've had a couple of questions, albeit from anonymous attendees. So if you are company XYZ, then you have an obligation to report your taxonomy aligned turnover, your taxonomy aligned capital expenditure, and your taxonomy aligned operational expenditure. So 3 items. I'll come to the timelines a little later, but that actually comes ahead of you, the bank, having to report a year ahead. And so as a bank, you're able to take the taxonomy aligned turnover from your self-reporting companies, or the taxonomy aligned expenditures, of which capital and operational, depending on how it relates to the underlying investee, you can take. Plus, as Gwen mentioned, you have an additional value, which could be the use of proceeds of particular instruments. And as you mentioned, Sean, that could be under the green bond standard, for example. So the aim is to make this reporting as straightforward and simple for you from readily available information that is out there.
Gwen, there are clearly some moving parts still in this. How does your bank deal with the uncertainty in this area? Because you've been looking at application already in the past. I mean, is this a big issue or not? There's the bits of uncertainty around how this is going to pan out in some sectors. You know, like gas and nuclear, for example. We'll come to that in a minute, which is not for BNP Paribas to comment on, but just in terms of levels of uncertainty.
I think that's always going to be the case, and as we mentioned earlier, this is really new. So a lot of the things that we're doing now is building towards what we hopefully will want it to look like in a few years' time. So this reporting and disclosures that we're going through, there's a learning curve that's part of it. So we're only going to know if they're pilots, and the sequencing phase that Nadia mentioned is how we're going to get there. And it's going to be uncertain anyway. When you deal with the markets, when you deal with finance, there's always uncertainty. You never know when things are going to happen. You never know. We didn't know that the pandemic was going to happen. And so we kind of just have to go with the flow and then try to see, in terms of the data systems that we have now, how is it we're going to collect that information? Where are the gaps? If there are gaps, then how do we have workarounds that will be part of that solution? And what else can we propose in order to get to the disclosures that we need?
Great point. It's about uncertainty. That's very interesting. Well, last time we did one of these 2 weeks ago, Nadia, we had someone from SPIE, who's an engineering company, talking about how they've done, I think it was 3 iterations of review of the taxonomy against their work, basically test runs going forward. Is that something that BNP Paribas has looked at doing? Have you managed in that fashion?
That's what we're doing now. We have a lot of legacy systems where our data is really stored in various places. So with the GAR, the Great Green Asset Ratio computation that was released recently, we're trying to see how do we map out what is taxonomy eligible, because as Nadia mentioned, for 22, we will all need to report on what is taxonomy eligible. And by doing so, we're not using MACE codes in BNP. We have our own industry codes. So we're trying to see, well, how do we map that with various MACE codes that are there? How do we look at what is NFRD, so non-financial reporting disclosure companies that we will need to report upon, because there are certain companies that are not within NFRD that we will need to report upon. And how do we actually do that decision tree to incorporate it into the process? Because what we see now is really, it's a theoretical equation. So what we're trying to do now is map it out. And then in terms of, for example, loan agreements that we ask our clients, what are additional questions that we need to put on there in order to answer some of the taxonomy requirements? So a classic example of that would be mortgages. We have a lot of retail mortgages in BNP Paribas. And for now, we are not asking any energy performance certificates. Mm-hmm. So for the next round, if we need to collect this information, then do we need to add EPCs, energy performance certificates, in the mortgage loan that we will ask our retail consumers?
Right, but obviously that's logical. I suppose I got to ask you, Gwen, because there's a lot of work here in doing this. Where are you sitting as you, it feels like you're sitting in a room surrounded by papers trying to sort out all these things in. Where do you sit in terms of your level of usefulness? Is this going to be, in the long run, from your perspective, useful for the bank and for sustainable finance, or do you think it's just not a regulatory burden? What's the feeling?
You probably have both. It depends on which department you're sitting in, probably.
Yeah.
I think that it will be very useful precisely for the main objective that taxonomy was created for. If we want to transition more capital towards sustainable projects, then the only way that we're going to be able to do that is to have transparent and comparable information across companies, across investors that we as financial institutions will be able to assess. But more importantly, we as individual retail investors will be able to look at and see, look, this is where I want to put my money. This is not green enough. This is not where I want to put my money. And hopefully, we'll be able to reach the goal of Fit for 55, which is the thing that came out recently from the European Commission. Good
point. Okay, thank you for that honest appreciation. I appreciate it. It's useful for people to hear. We'll get there, but there's still work involved.
It's not easy.
Nadia.
Yeah, it's not easy.
Not easy.
Sean,
Especially
before we jump to the next question, I know Marcella had a question specifically around the plastics example I gave. So I did want to just clarify that for any people that are super interested in plastics. So to demonstrate substantial contribution in plastics, you have to meet one of three things. So the very first one is whether the plastic you are making is fully manufactured by mechanical recycling of plastic waste. The second criteria is if mechanical recycling is not possible, and so therefore you are using a chemical recycling process, and you are recycling plastic waste using those chemicals, the life cycle greenhouse gas emissions of your manufactured plastic needs to perform better than plastics manufactured through fossil fuel means. And then the third criteria, so remember this is one of these three, the third is that your plastic that you are making is derived wholly or partially from what we are defining as renewable feedstock. Now within the taxonomy, we have specific requirements around what renewable feedstock means. So for example, under agricultural biomass, we have very specific requirements. But as long as you are meeting the lower GHG life cycle emissions in your process, then that would count. And I know we have a question around scope 3. And so relative to the question on scope 3, yes, it is embedded into key requirements for certain sectors where relevant. So when we refer to life cycle emissions, we are considering scope 3. For some other manufacturing means, so things like the manufacturing of cement, my favorite, scope 1 is what you would use relative to the European ETS, emissions trading system threshold that the taxonomy has in it. So leveraging the Compass would be good. I think we had a question about there being definitions on do no significant harm for other environmental objectives and how that relates to the fact that we've got new criteria. So if you kind of think about this on a normal distribution, so imagine companies are performing on a normal distribution, your top performance in effect is your substantial contribution, and maybe your bottom performance in effect is do no significant harm. It's not quite the same, but if in your mind you think of it that way, what we're going to be defining for the remaining 4 environmental objectives are these top end performers. What is substantial contribution? At the moment, what is do no significant harm is known and would be replicated when you're looking at substantial contribution. For example, for biodiversity, you could look at substantial contribution. You already know what the do no significant harm requirements are to the other environmental objectives because it's already published in the delegated acts.
Cool. We had one question about applicability to existing bonds and loans from Monica Bertoldato, which is interesting. And I will say there's a discussion underway about grandfathering or not, which is not defined yet. Nadia, do you want to just tell us where we're at so people know?
I would like to, but if it's okay, could we wait until a couple of the later slides? Because I think then we're going to go into green asset ratio.
That's a good cue to move ahead.
So kind of
key terms.
a back to basics look. And then I'll align this with the timetable as well. So you're going to hear language when I talk about the timeline related to eligible or not eligible and what that means. So if you could imagine a portfolio of loans, some of those loans will be eligible to the taxonomy. That just means that they are in activities that are covered by the Taxonomy Delegated Acts. So for example, those sectors that we showed you in an earlier slide, manufacturing and energy being some, if you're investing in those sectors or companies who operate in those sectors, that asset would be considered eligible. Not eligible would be certain sectors that at the moment are not covered within the taxonomy. So the manufacturer of pharmaceuticals, or at the moment, the manufacturer of kind of fashion and apparel, aren't yet specified within the technical annex. They may be in future, but at the moment they're not eligible. So eligible just gives you, in effect, the kind of cap or top bar of how much of what you're investing in has testing criteria for the taxonomy. It isn't necessarily a representation of how green anything is. You can have an eligible investment that is not taxonomy aligned and not operating in a way that is demonstrating substantial contribution. So then if we think about these eligible assets, we would go to the second pie chart here. And that really is broken into a portion that are not aligned, a portion that are aligned because they self-report that they are. And then I think Gwen mentioned this a little earlier around third country, and I'll come on to that. So if you're investing in a US company, if you're investing in a company from the Asia Pacific region, there is an opportunity at a later date within your reporting to use those estimated numbers within your own reporting. And we'll come on to that in the next slide, if that's all right, Sean.
Voila.
Yeah, in terms of when you have to do this. So from January 2022, non-financial corporates and financial corporates will have to report their taxonomy eligibility. Oh, I think we've jumped back a slide, Sean. From January...
Sorry, my apologies, I'm losing control.
No worries. From January 2023, non-financial corporates will start reporting their aligned turnover, Capex and OPEX. Now, if you remember, I said you've got a year. So banks, financial market participants, they start reporting in January 2024 on alignment, taking the turnover, Capex and OPEX of their underlying investee companies. So those who will have reported in January 2023. There is an option in January 2025 to start to consider estimates specifically of do no significant harm criteria for any third country investments. And that would be an inclusion of those estimates in your primary KPI. Now that is subject to a review clause. So if you've looked into Article 8, there is an Article 9 review clause that starts to talk about the inclusion of different types of assets. So maybe, Sean, it's worth us jumping to the next slide with just some of the technical detail around this. So as a general rule, exposure to governments and central banks and supranationals are excluded from numerator and denominator of the KPI. Now, what you will see is there a review period in mid-2024 that looks at the inclusion of central governments. Equally, small, medium-sized enterprises are currently excluded within reporting. And yet there's a review period in Article 9 that starts to consider how you would report under those. Now, for those companies who are investing in sovereigns or who are investing in SMEs or who are investing in third country companies, and that is a big part of their sustainability strategy, and they want to tell you about it, there is the opportunity to provide a voluntary report. Now that would be in complement to your main KPI. So you might say on a turnover basis, based on the EU underlying stock, I'm 5% taxonomy aligned. 70% of my holdings are not in scope, but I am able to estimate. And in a voluntary report, in complement to that KPI, you can start to tell the narrative around those additional assets that you're holding and how taxonomy aligned you believe them to be under a voluntary regime. Now, those estimates you can only use for third country in 2025. There are certain use of proceeds assets that would be considered to be permitted within your green asset ratio that I know Gwen will come to. And if we just jump to my last slide, Sean, before I hand to Gwen for a little bit more. So voluntary disclosures is something I get asked a lot, mainly because if you're only reporting about the EU component of your overall balance sheet, you may not consider that to be fully representative of everything you're doing. So the Delegated Act doesn't prohibit you using voluntary disclosures as part of your qualitative narrative of what you are doing. We would ask that any estimate alignment is disclosed separate from the KPI. And then similarly, sovereign green bond exposure could also be disclosed under the same voluntary regime. I will hand over, I think, now to Gwen to talk in a little bit more detail about specifically for banks, how this relates.
I'm just going to mention one thing about green bonds. So it is voluntary, but just in my opinion, if investors and banks and all actors are being required to disclose against taxonomy going forward, there's an incentive for them to maximize their disclosure. There's an incentive for them to find stuff to go in and not put things out. Because someone's going to ask Gwen, just how sustainable is BNP Paribas again compared to XYZ banks? This is what we expect to see. This is in fact what I think we are seeing already. So I would expect sovereign green bonds issuance to become aligned, even on a voluntary basis, remarkably quickly. Let me just put that out there for people to think about. But we've got to go to a couple more slides for Gwen. Now, Gwen, you're unfortunately on a phone. I appreciate this. This is the slide about KPIs for banks and credit institutions. A main KPI for on-balance sheet assets, the green asset ratio. Can you run us through the green asset ratio and what it means and how it relates to a bank?
Okay, I think that's the one after, but if I remember this slide correctly, if you look at what was released for Article 8 in terms of KPIs for the bank, so you guys heard from corporates, you guys heard from investors, it's worth looking back to the past webcasts and series that we had. And so for banks, there are 4 main KPIs. One of which is the most important one, because that's probably the one that we as banks are going to be using, and also what investors will be using when they look at us, which is the green asset ratio. Then the green asset ratio will cover stock and flow. For now, we're looking at stock. Then there's the off-balance sheet assets, which are the guarantees and AUM. So for us at BNP Paribas, for example, we have an insurance arm and we have an asset management arm. So the green investment ratio or the AUM that they would have would be reported under this KPI, AUM KPI that we have for banks. Then there are 2 other ones which will start in 2026. And this is something that we're still exploring in the platform with the commission. And this is on fees and commission and also on the trading book. So I think somebody had, I can see questions pop up. So that was one of the questions, I think, on KPIs, key performance indicator. Thank you from the climate bonds team. And if we go on to the next slide, I think this gives you an overview of what's in the numerator and denominator for the green asset ratio. So this is on balance sheet. We're looking at what is there in terms of loans and advances, debt securities, equities, any kind of repossessed collateral financing. If you go into Annex 6, there is a very comprehensive Excel file that walks you through each of the line items that would need to go into the green asset ratio. And as Nadia mentioned earlier, this is based on the 2 objectives that we already have delegated acts for, so climate change mitigation and climate change adaptation. And it doesn't include, for now, within this official KPI, sovereigns, derivatives, SMEs. However, for sovereigns, as Nadia mentioned, and for some SMEs, for example, if you're going to issue a green bond for an SME, then you are welcome as a bank, and this is what we think we're going to do as well, to disclose that within the voluntary basis that's available to us. I don't know if I want to pause here for any questions on green asset ratios before I go on to this one. This is on the timing.
Sure. Look, keep going, because we'll collect questions as we go along.
After. Okay, so Nadia walks through this already in the slide with the arrows and the timeline. So Article 8 goes into effect January 2022. This means that for fiscal year 21, by 22, we will need to declare, including banks and corporates and everybody else, that's NFRD, we will need to declare what is taxonomy eligible, and we will also have to include certain qualitative explanation as part of that. By 2023, so this is for fiscal year 22, corporates will need to declare their taxonomy alignment. However, for financial institutions, we still only declare what is taxonomy eligible. When we get to 24, we will then have the corporate disclosures to be able to use as part of our GAR computation for banks. And we will have a partial taxonomy alignment based on available data. However, for financial institutions, we still won't have this information. And then we will need to declare everything by 2025. So by then we will have to declare what is taxonomy aligned. Okay. And I think that's it for this slide.
Nadia, any comments to this particular point?
I've picked up a couple of questions and I'm happy to take them. So Pietro rightly was talking about turnover for enabling activities in the adaptation criteria. So we talked about turnover being something that's reported at the moment for substantial contribution to mitigation and adaptation. So under adaptation, you will see there's a little recital that says the turnover if you've adapted, i.e., let's imagine I'm a company, I've identified that I have climate-related risks in my operation, I've invested and I've mitigated all those risks. I can't claim that my turnover is taxonomy aligned. I can claim the capital expenditure that helped me remediate my climate-related risks, favouring nature-based solutions. But enablers, things like technology, can be considered as turnover. So if the enabler is facilitating the adaptation, then you can take a turnover metric. So what you would want to see in your taxonomy compass is there's a little T and a little E next to the plus sign. The E means enabling. And so under adaptation, that would count.
Give me an example. Enabling, what do you mean?
ICT, so technology, that would help you identify where you have climate-related risks and help you mitigate where those risks are and how you would ultimately adapt your business.
I can feel a lot of disclosure coming on in that area. Okay.
We had a question from Alina around how do I know what an NFRD company is? We keep talking about the scoping of that. So the non-financial reporting disclosure applies at the moment to EU companies with greater than 500 employees. In a sizing document, this is just under 2,000 companies, including banks and insurers. What you might find for the non-financial reporting directive is it's transposed to local legislation. So you might see numbers like 11,500 companies, but those are not companies. So in local legislation, NFRD can size to things like UCITS funds or legal persons or state-owned infrastructure, for example, depending on how it's been transposed into local legislation. Those aren't things we would expect to report under the taxonomy. It's more those companies who themselves are in scope. Now, the non-financial reporting directive will turn into the corporate sustainability reporting directive. And I know we love an acronym, so CSRD, and that's in January 2024. It's expected that the scope will increase to companies with greater than 250 employees, and also potentially increase to international companies who list on an EU regulated market. It's still in design, so some of those details are to be fully fleshed out, but it's something for people to be aware of. So that's what I picked up in the Q&A at the moment, Sean.
Fantastic. Just there are a few other questions too. One I wanted to throw at you, and Gwen first. You got a general loan to a company. That company is using some of it, you've been able to find out, for compliant activities. But it's a general loan. Just how are you disclosing that exactly? So if they tell you that they're using a part of that loan to do something compliant, do you then pass on the disclosure up the food chain?
That's what we would do for general purpose loans and general purpose bonds. So we would take what the company itself discloses as their taxonomy alignment, both as Capex and as turnover, and we would pass that on through in terms of our calculation.
Great.
We will only have something more precise if it's use of proceeds. And then that would go back into what are the funds actually being used for, and if it fits the various decision tree that Nadia had walked through earlier.
Nadia, if someone like a car company is borrowing to put solar on the rooftops of the factory, but the car plant is still a diesel plant, which doesn't qualify, do we count the loan to the solar on the top, even though it's powering a car plant? How do we deal with that?
Oh, Sean, you always ask the really difficult questions. So my understanding, but I want to kind of caveat this with, I might be wrong in this understanding. My understanding is it talks specifically about the project. So if, for example, I'm a supermarket, and supermarkets at the moment are not really covered, there's no technical screening criteria for being a good supermarket, but maybe I'm updating my warehouse to generate kind of 30% energy efficiency savings, like you say, Sean, making sure it's solar powered, then the capital expenditure, in my opinion, that goes into the retrofit of my warehouse would be considered to be taxonomy aligned, is my understanding.
Absolutely. Okay. A car plant could be complicated by doing no severe harm measures, in the sense that you can't build a railway line to a coal-fired power station. That's very explicit. So building stuff that is positive but is directly contributing to the manufacture of something that is not seen as positive in the taxonomy could be a problem. So there are some areas that are spelt out. There are some areas that aren't. There's a bit of fine detail. You need to go to the Taxonomy Compass to have a close look at this. So in the car plant, it will depend on, is the solar plant specifically for that generating of diesel engines, or is it a general mix? Is it getting used for a variety of installations, including office spaces? These things are material to thinking through these questions. We've had a few more questions like that. Sorry, go ahead.
No, I was just going to say, maybe just another plug for the EU Compass is, I've pulled in front of me right now renovation of existing buildings. And if you're looking at substantial contribution criteria for climate mitigation, then it says that you need to have a reduction of primary energy demand of at least 30%. If I'm looking at the description of what is substantial contribution for climate adaptation in terms of renovating these buildings, there's a whole list of things in there that you're going to have. But what's more important is on the do no significant harm criteria. It says that this building can't be dedicated to extraction, storage, transport, or manufacture of fossil fuels. So it really depends on what activity you're looking at, and go to the compass.
Exactly right. Thank you. Beautiful example.
We've got one extra question
go ahead.
from Francesco on bank-on-bank eligibility. And I think we had another question from another attendee around, I don't know eligibility until I'm given eligibility. What do I do if we all have to report it at the same point in time? And then we also have another question about eligibility if a company is kind of part doing something, part not doing something. What do I do? So we'll try and answer a couple of those. So we'll start with the last question. If I have a loan and it's a general purpose loan and it's to a company that is 50%, let me try 50% manufacturing iron and steel and 50% manufacturing copper. I don't know if such a company exists. We don't have copper criteria, we do have iron and steel. So you can say 50% of the revenue made by that company is taxonomy eligible, insofar as you can then test the iron and steel relative to the KPI within the taxonomy. So you can use proportion. What you will find is that most of these companies will already be reporting their segment revenue. So if you look at the fiscal year ending 2020 data, you will be able to see most of these in-scope companies will already be telling you the proportional breakout. Now, if you wanted to map that proportional breakout to whether it's taxonomy eligible or not, the platform have actually worked on a solution that supports NACE. So NACE is used at the moment to define eligibility. NACE doesn't 100% cover the taxonomy. So for example, at the moment, it doesn't include certain renewable energy technologies or hydrogen as a standalone NACE code. So we would always recommend you defer to the description of the activity within the delegated act to understand what it covers. Now, what we in the platform have done, and it should be published, I believe this week or maybe next in the Commission's website, is we've mapped the taxonomy activities to other classification systems. So that would be a BICS, a GICS, a TRBC, or various classification systems from other vendors that you may be using. And that would allow you, if you're currently mapping revenue in your infrastructure, to leverage whatever classification you're using to see whether a company is taxonomy eligible or not. One thing I would caution against is sometimes those classifications that you might hold are talking about the company as a whole, i.e. the majority of revenue comes from doing something. What you want to do is you want to get that segment revenue. So you want to see the proportion of that company that can then be mapped to the taxonomy as eligible.
Now, this is going to be incredibly useful for understanding the extent to which the European economy is already sustainable in terms of the taxonomy, because we don't really know at the moment. The disclosure hasn't been there, the reporting hasn't been there, there's been a lot of wild guesswork, but we simply don't know how far along the road to what we got to we are, right? So this is going to be, well, going back to Gwen, that'll be one extra positive contribution, I guess, by the time we finish this. Gwen, a question for you. What about underwriting? Does this affect your investment bank operations? I mean, sure, you've got to disclose loans, but if you're structuring a bond for another party and earning a fee, how does that factor into your reporting?
So for the bond itself, if it's not on our balance, we will have on balance sheet debt securities through our ALMT. If we're underwriting it, at some point we're holding it for a specific amount before it gets distributed to end investors. So here we're still trying to figure out, well, what is the actual time that you're going to have to hold that, and what is the reporting date? Is it like in accounting where it's where you hold it as of the time that you report, or how would that actually work? So this is a question mark still for us. And then second, I think it's also the type of bonds that we will eventually underwrite, because if we're looking at green bonds or EU green bonds, and then those ones will probably be more aligned with the taxonomy as we go forward. So there's two angles to it.
Does it make any difference if you're structuring bonds in Latin America versus in Europe from your purposes, or is it just the same approach? I mean, especially bonds issued in Latin America and how you tackle those, which might have a different framework, but you want to look at them against the EU taxonomy. Will you do that?
We don't know yet, because for now, we're only looking at what's in the EU, because that's what's covered for disclosure purposes. Okay. But what we would like, and I think this is in line with what the other global banks out there are looking at, is really a conversion or equivalence of the various international standards that are out there, especially on what's going on, because if we have to start disclosing.
Oh, we've lost Gwen for a minute.
It was going to be good as well, I think.
Oh. Gwen, that was good. We need you to repeat it. We lost you for 30 seconds. Just repeat that last point.
International standards, they need to start converging, or at least have an equivalence, because I think that's going to make our lives a lot easier given all the complexity that's coming to our way now.
So true, so true. And of course, our friends at the Commission, you heard it here, because we're trying to encourage the Commission to sort this out for us. But I will say there is progress. Under the International Platform of Sustainable Finance, the EU-led coalition of, well, currently representing 55% of global GDP, there is a working group, I know because I've had some involvement in it, looking at how to harmonise or provide a common ground taxonomy between China and Europe. And a report will be published in autumn, we hope in September, looking at a first cut of that. And according to the governor of the Central Bank of China, the People's Bank of China, that is supposed to be 80% common between Europe and China. I must admit he gave me conniptions when he said that, because I thought, oh God, there's a benchmark we've got to reach. But you get where we're going. And that's two very different conceptual frameworks. We're looking at coming up with a common approach, which looks at what is equal in each of them, line by line, and then can be shared with other countries around the world. So there is work underway at trying to provide a common approach. There's also a discussion in the European Green Bond Standard about the importance of addressing equivalence, as Gwen raised. Under the International Platform on Sustainable Finance, there is also a dialogue of other countries who are looking at this very issue. South Korea's got a draft taxonomy out. For those of you interested, the South African Treasury has got a consultation about their draft taxonomy out right now. It's very similar to the European taxonomy in many ways, but there are differences. They're looking for feedback. The Colombian government, the Chilean government, the Singapore government all have taxonomy projects underway. So this is happening around the world as we speak, essentially. And of course, the UK government now has its own taxonomy committee, which is meaning the Treasury has said it will be based on the European taxonomy, but have some flourishes for the UK. We can probably guess what they are. One of those will be nuclear, which has been very clearly will be included in the UK taxonomy because the UK government has a very strong program or commitment, I suppose, to the nuclear agenda. In Europe, this is still a source of some discussion and debate. The European Commission has said that in Q4 of this year, it will have a closer look at the gas and the nuclear issues, both of which are not currently, just to be very clear to everyone, they are not currently in the Act. So with the Delegated Act, it's currently before the European Parliament. The Commission has adopted, when it comes to energy, exactly what the technical expert group recommended last March, and Nadia and I were on that group, which was that there should be a 100-gram threshold for CO2 equivalent kilowatt hour for energy, which would exclude unabated gas, that is gas without carbon capture and sequestration, and would require the measurement of fugitive emissions, and also would exclude nuclear until the Commission can launch a more detailed inquiry looking at the do no significant harm measures. We made very clear nuclear is low carbon. Don't be confused about that issue. But of course, there are some very substantial concerns around disposal of waste, around decommissioning and so on, that to address the sustainability of the investment need to be adequately considered, way above our pay grade at that point. So there's a series of inquiries underway. So that's where those two are going, folks. They're not off the agenda, but they're not on the agenda just yet. There's looking at further examination. The Commission has said there may well be, I think what they call a transition, let's call it an amber taxonomy, where things like some forms of gas might be allowed. We live in a democracy. There are a number of member states that are not very keen on the technical expert group's recommendations and are saying we need to do X, Y, and Z. The Commission is trying to find a pathway through this, this complex democratic conversation to go through. So watch this space. But that gives you an update of where we are now, both in Europe on those issues, and more to the point, internationally, the move towards working together in taxonomies around the world. Well, first, there are now taxonomies around, thanks to the European work. Everyone, every man and the dog's trying to have a taxonomy, I'm going to say. But the move toward bringing them together is well and truly underway. Okay, a couple of more questions. Nadia, you've been diligently watching the Q&A. Thank you so much for this. Any more you want to address now?
There are a couple kind of feeding through. So one of them was a question around kind of bank-on-bank reporting. So I don't know the reporting of alignment of a bank until a bank tells me the reporting of its alignment if I am investing in that bank. And I think that's fair and true. And you may not have a complete picture of your green asset ratio until the consecutive year. And that will be true of everyone. There is a question about the ability to work out eligibility of capital expenditure or operational expenditure. I completely agree with the concerns here that it's very difficult to proxy. So it may be more appropriate, at least in your first year, to only be reporting eligibility as proxies to turnover. in the absence of having true reported data on which to base your capital expenditure or operational expenditure numbers. And I think there will be a degree of flexibility. I'm not speaking on behalf of the Commission, but my expectation is if there's not the data for you to rely on, it's going to be very difficult for you to report that accurately and correctly in the first year. And so on a best efforts basis, to be able to get the data that you need in order to onward report would be wise. And I think there's an understanding that that will be a staggered approach. As you can see in this slide, the data will become more and more accessible to you, and your reporting will become richer and more accurate over time.
Okay, let's just move on now to the last couple of slides. All these slides will be available at the Climate Bonds/webinars page. Which is, if you go to the Climate Bonds website, you'll find them all. This entire webinar, of course, with the slides, will be available on YouTube, and you'll see on the last slide the search term you can use to find it. Tell us about this slide, about interaction with NFRD and CSRD. I think we've covered this largely.
We've covered this.
So let's move on quickly, because we've got a few minutes left to look at other topics that we want to address. Doris Kramer, our technical expert group member and from KfW, has asked the question: assuming BNP Paribas issues green EU green bonds, how do you report in order to avoid double counting? You've got an overall green asset ratio is 20%. Your green bond green asset ratio is 100%. Are you deducting something? What are you doing here, Gwen? How do you do that?
If we're issuing the bond through so that's issued through our ALMT, and then that's on our balance sheet. So it's in fact in our green asset ratio. So we're not double counting anything.
Got it. Okay. Very clear. Doris, please come back to us if you think if there's any further questions of that. In the question of binary to ratings, Nadia, this is a forward-thinking question. This is necessarily a fairly binary approach that we've adopted in the taxonomy so far, and I might describe it to everyone as setting what investment grade environmental is, or investment grade sustainability, which is in the bond area. Well, it's my area, excuse me for all those people who don't know bonds, a double B or a double B minus, or even double B plus, depending on how you calculate it, will be investment grade, and then you might have shades of green above that. But the idea is, if you're below investment grade, you should really be doing it, or you've really got to be thinking twice about whether it qualifies. Now, I'm going to put that as refer you to the webinar we did last week with Nancy Sage on the significant harm and no significant impact taxonomy, which starts to wrestle with this issue of the medium things, the things that are in between the, let's call it, significant harm and clearly sustainable investment. So we're starting to tackle that issue. But in the meantime, do you think we'll end up seeing ratings, shades of green going forward? Or is that something we just leave to the market to sort out while we just set a minimum hurdle here, Nadia? What's your thought going forward?
It's a really interesting question, Sean, in terms of shades of green. And I think you're right to point out the material that Nancy shared. And definitely, I would say it's open to consultation. It's certainly open to people's views. I think we'd be really interested in it. At the moment, what we've talked about is, in order to qualify, even though we talked about transitioning, we're talking about transitioning so that at maturity, it is substantially contributing. One of the questions I get asked is, what if I'm investing in a transitioning activity that takes it out of harm and into a neutral space and not quite ready to meet that substantial contribution? Should I be able to have credit for that financing? And that will be something that we will debate in consultation on that material. And I would definitely encourage people to look at it and share their opinion with us, because it is something we in the platform are talking about.
So forward-looking things are still up in the air, folks. You get a chance to contribute. And note that we're currently looking for consultations around the significant harm and the social taxonomy framework. Please do make a comment. And I think we're now looking for comment what's the timing on this, for the circular economy, the pollution prevention, and so on. Remind us what the consultation period for the other aspects of the forward taxonomy is, Nadia.
Oh gosh, the timings. I think it's open pretty much now until, maybe I'm getting this wrong, the 27th of August is what I want to say, but I don't have it in front of me. So it's maybe 26th, 27th. When do you know? Yeah, I'm there.
Yeah, it's that because it's around my birthday.
So look, it's a summer holiday. It's a summer holiday job.
Yeah.
I'm sorry to have to say.
Sean, can I quickly answer Bettina's question, because she has kindly reposted it for us, and her question was related to do no significant harm and what's the requirement on a financial organization for verification of do no significant harm. And what I would say is, if you are taking the do no significant harm self-disclosure of a company that themselves are subject to this Article 8 disclosure, then there is no requirement within Article 8 Delegated Act that you have to kind of conduct any further due diligence related to their disclosure. Now, there is a clause, and it has been picked up in some other questions, in Article 7 of the Delegated Act to Article 8, and that actually permits the use of estimates for do no significant harm for third country activities. And this again was the point we were making for reporting after January 2025. Now, the requirement there is that third country company has reported their own substantial contribution, but where you have had to use proxies or estimates, and there are criteria written in the Delegated Act that estimate would need to meet. And I would say that there will be more work and more guidance that we will be looking to do specifically in the platform to help people around the questions of where can I use estimates either in voluntary reporting, or where can I use estimates and what's the due diligence expected of me where I'm looking at third country companies, because there's a lot of questions coming through on that.
Nadia, wasn't there also a clause in there on having a third-party verification on any kind of estimate or methodology that we end up doing on DNSH if we don't get it from a company?
At the moment, the language that it uses is that those who use these estimates should formalize, document, and make public the methodology upon which estimates are based, including approach and research methodology, the main assumptions, and importantly, precautionary principles used. There's nothing written in the legislation that talks about independent third-party verification of any such data sets at this stage.
So watch this space on that question, but we've had a couple of questions about verification. So at this stage, for disclosure, it is simply about disclosure. There is no requirement for verification. Of course, there is an issue that regulators will be collecting this data and reviewing it. So I guess, Nadia, that a citizen or an NGO, more likely, could complain about formal disclosure if they get access to information, and that would lead to some kind of investigation. Will they be able to get access to disclosures? Will this be public information?
Public information from companies, yes.
Well, BNP Paribas, for example.
Well, we would need to disclose our green asset ratio, and there would be an explanation associated with that. So it's similar, I think, to our CSR report or our TCFD report, which is already online and it's publicly available. I would think for everybody that would need to disclose, it would be public information.
Perfect. That's exactly right. So you'll be able to interrogate, look at it, and in this case, you could potentially send a letter to a regulator saying, can you have a look at this? And it'll be up to the regulator to see what they can manage and what they can handle and if they want to pursue it and ask questions. But the key point, the objective here, is to get a common approach to disclosure. Because at the moment, well, I don't know, Gwen, whether this is happening in France, but certainly across Europe, you get many different institutions having different approaches to describing what is sustainable, what is ESG, what is green. And out of all of this, at least we'll get comparability, which has been a significant challenge in the past.
If you look at what we in BNP Paribas is disclosing within our CSR report, we have our financing and investment in SDGs. And if you look at our competitor banks, they have something similar. But when you compare the methodology of how we're actually getting to that number, it's apples to oranges. So it's very hard to do a comparability study. So with the taxonomy and something that is regulated, that we know where it's coming from, we know where the numbers are, how the numbers are being computed, then that'll help us with this apples to apples comparison.
Fantastic. We need to wrap up with the last stages. Thank you for this great conversation. Nadia, have we missed anything in the Q&A? I think we've covered a lot of territory.
One tiny point, which is, do we need to meet a particular limit? Like, do I need to be a certain percentage taxonomy aligned? And the answer there is no, you don't. There are labelings that may come about from hitting a certain target, but at the moment it is just a disclosure regulation. So you could be 1% aligned, you could be 10% aligned. There's no limit to hit.
Now that might change where incentives, which is a separate project, would be attached to some form of disclosure. And we've had a conversation in the European Commission about the idea of risk weighting differential in the capital ratio requirements of banks attached to green bonds and possibly other green investments. So we'll see where that discussion goes, but clearly they will need to send a clear hurdle rate for what level of a compliance might need to be. It may be simply green bonds, 100% green bonds. We're not sure. In the Hungarian central bank already has capital ratio benefit if you hold green mortgage bonds up to a certain level. The Chinese government is bringing this in, they're saying they're bringing this in for the People's Bank of China. They already have, by the way, in China, a discount capital available for banks at the liquidity lending window of the central bank if you post green bonds as collateral. Green bonds as defined by the Green Produce Catalogue in China, which defines the green bond market. They get a 1% discount on wholesale funds. Nice. Now, I'm sure BNP Paribas would find that an attractive proposition if we could find that, if we could make that happen. We do know there's a discussion underway. We do know also that Christine Lagarde, in the early days of her current job at the ECB, talked about the opportunity for green quantitative easing, where green, the term, would be linked to the taxonomy. Similar kind of issue, but there'll be a need for thresholds. That's up to other people to work it out. This is a disclosure tool, which can then be used by a variety of other parties or a variety of other measures to be pursued by the European Commission or even member states. We'll see a flourishing of ideas now that we have a common framework, or at least about to come in. So that's the important thing to note about this. This is not in its own right a do not or do this thing only. It is a disclosure tool, but of course, it's a disclosure tool with an ambition to encourage people to do more of sustainable activities. Nadia, Gwen, thank you so much for your time today. Thank you for participating in this event. Nadia, who has put in, I'm going to say, years of work on the technical expert group, on the EU platform on sustainable finance. God knows how Bloomberg must appreciate how good she is, because she's still there as head of sustainable finance. And then Gwen, who has been putting in so much work within the bank, as well as the platform, to try and get all of these ducks aligned, which is quite a challenge. Head of Sustainable Business Strategy and Innovation at BNP Paribas. Thank you so much for being with us today. To all our listeners, it's a huge challenge. We have to. It is an existential challenge, frankly, for the planet, for the economy, for our children, to move our society onto a sustainable footing when patently, at least in the area of climate change, it is not. Think of the heat incidences, and you read the science about how much these heat incidents are tied to climate change. It is coming out in droves. We are moving to much more frequent extreme weather quite quickly. We now need to stop catastrophic weather going forward. This is an attempt, part of a mosaic of solutions, of initiatives to shift the needle on capital investment in creating a sustainable future. Do look at the EU Action Plan on Sustainable Finance released last week. Do look at the other measures that have been contemplated around the world in many countries. That's the good news, that we're making progress in that. But above all, do look at what you can do in your own work to help us achieve a future that is both sustainable in returns and sustainable for our children. Thank you for listening. This webinar will be available on YouTube. You can search for Climate Bonds EU Taxonomy, or on the climatebonds.net website, look for webinars. It'll take another day to get up there, but you'll be able to get the slide deck from there as well. All of this will become available, and on the side of the screen, you will see the other webinars we've been holding over the last 6 weeks. They're all available publicly. Spread the word, contribute to our consultations, but above all,